This module we're going to be talking about equity, specifically the topic of retained earnings. So first of all, let's look into retained earnings and talk about what really retained earnings is. Retained earnings, this is the account that tracks all the net income this company has ever had over its life, less any amount of dividends that it's paid out. So in other words, it's the retained earnings versus the distributed earnings. How much of the earnings have you retained in the company for future uses? It could be for future uses as far as buying more equipment, expanding, whatever those future uses are. This is the earning amount that you've retained. Now, investors, if you have stock and you see a company that continually increases the retained earnings, you may see this as a potential source of information for what dividends may be issued in the future. It's not a guarantee. Ultimately, it's up to the board of directors to determine what dividends they're going to pay. The company needs to decide, is it wise to retain those earnings and finance themselves, or is it wiser to distribute the earnings out to the investors, to the owners, and they would do that if there was no real good reason to keep them, if they had no future plans for that money. So let's take a look at how certain things impact retained earnings. First of all, we said the net income increases retained earnings. So revenues increase net income, which increase retained earnings. Expenses, they decrease net income, therefore they decrease retained earnings. Now, dividends are not an expense. They don't impact net income. Instead, they directly reduce retained earnings. Now, the reason for that is that a dividend is a distribution of those retained earnings. So we've decided to no longer retain them. Instead, we're distributing them. Now, later on in other modules, we'll be talking about a couple of additional topics such as treasury stock and stock dividends. But what I want to tell you right now is that they do have an impact on retained earnings. We'll see later that treasury stock that's issued below cost, this will decrease retained earnings. Now, there's a discussion here with additional paid-in capital. Just briefly, I'll try to touch on this without getting into too much detail. With treasury stock, this is when we buy back stock from the open market and we hold it temporarily as treasury stock, we as the company. So if we buy the stock back at $10 per share, we may decide to later on sell it for $5 per share. That's the going price. We didn't really want to sell it for $5, but that's the price just has settled down that low amount. So if we sell it at that lower amount, it's not really a gain or loss. It's not a loss in that case, but it does impact retained earnings. Now, if we sell it at a higher price, we can set up what's known as the additional paid-in capital for treasury stock, and that amount helps to offset any future situations where we sell it below cost. But if we don't have enough of that fund set up, that's when we have to hit retained earnings. Now again, this discussion will make more sense in our treasury stock module, but I just wanted to touch on it here because this could reduce retained earnings. Stock dividends also decrease retained earnings. This is actually known as capitalizing retained earnings. What will happen here is if we issue a stock dividend instead of a cash dividend, we are moving money out of retained earnings. That's really just like we would with even a cash dividend. We reduce retained earnings, but the difference with a stock dividend is that amount of money gets moved right over to the capital accounts, the other capital accounts, common stock, preferred stock. So we are still decreasing retained earnings. Now, a company could have various restrictions to retained earnings. As we said earlier in the first slide, when an investor looks at retained earnings, they see that amount as the potential dividend payments in the future. So if the board of directors wants to make sure that the investors realize they're not going to be paid those dividends, they may have appropriated retained earnings. This is a voluntary restriction to signal to investors that this retained earnings amount is not available for dividends. Instead, it's going to be used to purchase a new building down the road or whatever. There may also be legal restrictions. For example, a contractual obligation. If you borrow money or if you issue bonds, there may be a debt covenant in there saying you're restricted from paying too much in dividends. It may give you a certain percentage or cap that you have to keep retained earnings at. So you can't pay below that amount. We talked briefly in the earlier module about the par value and the legal capital. This does the same basic thing. It restricts retained earnings from falling below a certain amount. Now, we said earlier that companies cannot pay dividends in an amount greater than retained earnings. They're limited to whatever the retained earnings are. You can't distribute more earnings than you've retained. So you cannot force a negative retained earnings. However, let's say you pay the retained earnings down to zero. And then if in the next period you have a loss, a net loss, negative net income, this would create a negative retained earnings situation. This is referred to as an accumulated deficit. Now, by itself, you can have negative retained earnings and you still have plenty of common stock, plenty of preferred stock, so overall equity is still positive. But if the negative retained earnings is large enough, it may offset those capital accounts, and you could end up with negative equity overall. Now, I said earlier in an earlier module that that's a bad situation because it generally means the company is on the verge of going out of business unless they can turn things around really quickly. If the company liquidates when equity is negative, this means generally that the creditors will not get all of their money because there's not enough assets to cover the debt. That's why you have negative equity. The last two things I wanted to illustrate are the different ways of showing retained earnings, the different statements you may see for retained earnings. So here we have an actual statement of retained earnings itself. You have the beginning retained earnings balance, which this amount would have been last year's ending balance. You add in net income for the period. You subtract out dividends declared. And of course, we said earlier you have any treasury stock reissuances below cost. That may reduce retained earnings as well. And you end up with your ending retained earnings balance. There's a more inclusive statement known as the Statement of Changes in Stockholders' Equity. This shows all of your equity account and what the changes were that impacted them. You're going to have a retained earnings section in there showing the beginning balance, any changes, net income, subtract out cash dividends, subtract out treasury stock reissuances. So that would be a situation there as well. And then it all rolls up to the total. So that should cover retained earnings at a high level, enough to get you further on in the equity section.